So welcome to the third of our Hacking Finance podcast discussions between founder of Anthemis, Sean Park, and myself, David Galbraith. In the previous two, we looked to start with the sort of geopolitical internet, i.e. the very macro view. And then last time we talked about embedded finance, which is the sort of the specific structural view we have. And I thought this time we could maybe talk about specific products and business models, i.e. getting down into the tactical. And I was going to kick off with very much my sort of view of the world, having come from consumer internet, and then pass it to Sean to say sort of where his worldview comes from. So my worldview in terms of product and business models comes from two things. One is having been an architect and focusing on design and simplicity, and seeing products like Stripe really win when in spaces that people thought were over, due to companies like WorldPay, for example. And then having just design elegance, clarity of business model, and fantastic documentation, and just executing really well on something from a design perspective, to my mind. The second thing is that I think because people talk about technology investment, that people assume that people are investing in technology. And I would argue that when I was working on the consumer internet side, things were very much about distribution. And what the internet did was allow you to leverage a network for distribution using commoditized technology. So actually technology investment is in some ways not really about technology investment. It's about leveraging network effects.
Well, or I would say it's a misnomer, it's mislabeled, right? And it's, this is a sort of bee in my bonnet. It's not that important in semantics, but you said like now, but now it's becoming obvious that sort of this bad label, that even when they talk about the tech stocks, well, no, you've got like a shopping, an infrastructure, everything's a tech company. I imagine, I don't know if they had these discussions in 1915, is like, okay, everything's an electricity company or a production line company. It's not a separate category. And actually, I was just saying to intervene because there are tech companies, right? Or technology, and that would maybe be, I think what you want to talk, we'll come to this, but like deep tech or, the actual technology, whether it's, and then there's various different categories, I guess, medical, computing, energy, whatever. But we get hung up on these labels, right? And so, Silicon Valley is still seen as like tech investors, whereas, they invest in consumer products, business products, and
but I do think it's a useful lens to actively push back on technology, because I think, Amazon, Google, Facebook all leverage lots of open source software, for example. It's part of the idea that technology became very commoditized, that drove the ability to leverage new business models. And even before the internet companies, it was Microsoft. Microsoft were leveraging lower marginal costs of distributing software versus physical products.
But like Facebook isn't any more of a tech company than JP Morgan, right? They both, fundamentally rely on technology to deliver their products and services, but they're not tech companies per se.
Yeah. And I think even as we've seen, I guess because technology sounds cool and people like saying they're investing in deep tech and things like that, because it has some sort of kudos. And
I want to meet the person investing in shallow tech. That's
exactly. No, I think shallow tech's probably much more interesting. Commoditized tech with distribution. And I think some of these really, really marketing savvy startups, like I say,
I wonder if we could raise a fund for that, David. Shallow tech.
In shallow alto. Yeah. So, I mean, my view of the deep tech stuff is that it's actually it's the commoditization of technology lower down the stack. So we're seeing lots, because we now know that chipsets are designed and then manufactured in Taiwan by separate companies like ARM that design them. There's a whole plethora of people designing custom chips now, particularly for AI, because that's commoditized the software component. And so that appears to be very technical because
There
it's.
was, and this is way beyond my pay grade knowledge scale, but like in the early noughties, probably still today, but there was, you know, a lot of innovation sometimes comes out of, you know, they say in consumer, it comes out of, you know, it's like porn and gambling are the first things to, in the more institutional space, it was often finance because that's where the money was. And there's these huge sums of money. And there was a lot of chips, proprietary chips designed for high-speed trading because somebody could afford to say, okay, yeah, I'm going to invest $200 million in a chip design because if I get it right, I'm going to make, you know, 20 billion. But you know, it seems to me, I'm just trying to figure, are you saying like that's becoming maybe not democratized completely, but more generalized because the cost of developing a new chip design is maybe lower and the use cases or the relative advantage of optimization is higher. So rather than using a general CPU for everything.
I think we're seeing a paradigm shift in terms of away from Intel, away from integer-based math to floating point arithmetic, away from algorithms. Actually, when people talk about algorithms with AI, machine learning, I find it weird because it's kind of a universal algorithm. And so that all of those changes and that commoditization mean that this stuff that's very low, the very bottom bit of computing is being reinvented. And like you say, a lot of those things have been driven by finance because they're very extreme use cases for doing things very, very quickly, or quickly or securely. So the architectures of finance are very interesting for those reasons because they're a bit like, you know, when the byproducts of NASA become Velcro or whatever and things like that. You get these byproducts from very extreme use cases. And my view is that this stuff has been mislabeled as deep tech, and it's not. It's the commoditization and the leveraging of network effects further down the stack.
Maybe just as a contrast, is there anything? What would you characterize as deep tech? You know, in terms of doing the semantic parsing, what are things that actually would be deep tech?
I think some of the crypto, some of the really hardcore,
Quantum computing,
zero knowledge proofs. Okay, yeah, exactly. So it's stuff that I guess it's the stuff that's closer to university, where the intellectual property is what's valuable. I mean, it's rare for startups actually for the patents to be that important. It's more about how you can capture market share. So it's the stuff where the intellectual property is protectable and important, I guess. And there's not a lot of that.
Homomorphic encryption.
Homomorphic encryption, I think, is one of those ones that might genuinely be the real deal. But you can imagine, I think it's a bit like biotech investing. You've got to be really, really knowledgeable about the entire sector to know where to place the bets.
Yeah.
So yeah, I think we're definitely seeing that transformation there, and that's creating new business models. I mean, the other area I know that I'm fascinated by at the moment is applying this model, which we knew worked for consumer internet. We knew that you could have billions of users using Facebook because of network effects. But when arguably Yammer became the first company to do this, and you have a lot of B2B companies now that are leveraging the ability for people in an organization to circumvent the normal, slow, bureaucratic decision-making process for enterprise sales. So, and I think there are two models for that. And one is SaaS, where the model is what can you expense without asking your boss to the
that was the Salesforce playbook.
Yeah, till the point where you then, after the fact, roll up all the licenses into one enterprise sale. And the other is APIs, where you are making things easy for junior developers to just build something without asking for permission. And I think those two things are transforming the world of enterprise software.
And do you think on the API side, on the developer tool side, especially in larger organizations, do you think there's an element of the procurement or management, the traditional procurement or management supply chain, authorization chains or organizational frameworks don't really understand what things are. So they're used to their technology people, asking to buy, hardware historically, now probably asking to, have pay for computer storage on Azure or AWS or what have you. And so when there's a line item that's an API call or whatever, there's a bit of an arbitrage because they can they don't know what that, oh, that's just some IT stuff.
Yeah, exactly.
It's within budget-ish. Do you think there's an element of that? Or I was thinking about that the other day. Where
It's an interesting idea that things go below the radar because they are new things that are. I don't know if you saw this burger restaurant that named its burgers things like mouse pad or like USB drive or things like that, so people could expense the burgers. It's maybe a sort of form of that.
That's brilliant. Okay.
Yeah. So yeah, I mean, I'm sure there is a degree of that going on where, but that's definitely the game. Is like what can you get away with without asking for permission to the point where it's just going to be blocked. And I think it even goes beyond that, because we know that when people do RFPs and things like that, or when traditional enterprise sales teams engage, there's no incentive for whoever's doing the sale to not promise lots of features, and it actually makes the product worse.
Yeah.
So you ended up with these consumer products that are elegant because of the features they left out. They didn't have the bloat in them. Yeah. And I think we're seeing a real transformation where what really struck me actually on this was when you saw the inside of the SpaceX rockets, the interface, because it looked like a Tesla. It was just a bunch of screens. There were no, like, you assumed that like pro rocket astronauts was lots of dials and switching and like real hardware with like the perspex things over them that stop you pushing them. And suddenly it was like that all went away and it looked almost consumer, the interface of the
I have to admit, I did see that, and what struck me was I always thought that the analog, sort of as you say, the dials and stuff, and the mechanical, those are actually, safety things, right? Like there's an element. It's like all the like the fly-by-wire planes that they're fine unless the electronics go down, and then you kind of wish you had a cable attaching to the aileron, right?
I can imagine the sort of the squidginess of the flat screen interface. The guy like licking his finger because it's not working, or trying to dry his finger. I don't know.
Yeah. Or the ability to, I don't know. I guess then I thought, well, if things go wrong in that kind of environment, you're kind of probably screwed anyways. So. But there was stories, wasn't there, from like the Apollo, this is a rabbit hole, but like where they fix things sort of MacGyver like, right? And it would seem to me like with those kind of interfaces, there's nothing that can be fixed, right?
Yeah, I think that's it. I think it was Richard Feynman, when he was looking at the shuttle disaster, sort of examined how the shuttle worked, and it turned out that the bit about landing the shuttle was just to make the astronauts feel they were useful, because actually they weren't doing anything. So maybe SpaceX has just taken it to that, and it's not an interface that's consumer or not. It's just there is no interface. But it certainly has an elegance, I think.
So you're suggesting that it's all just like Truman Show?
Yeah, I'm sure.
The astronauts think they're doing stuff, but they're not really.
100 tons of kerosene and a bunch of fake screens. Yeah. So, so getting back to enterprise interfaces, I do think, I think we're seeing three things happen. We saw that we saw network effects push for consumer internet in fintech, because often you're dealing in environments that are a bit, it's people's money, it's a bit serious, that are on the side of B2B. And so we're seeing the internet model for B2B playing out very well in fintech, and this deep tech thing I think will play into fintech as well, because I suspect that a lot of, particularly for insurance, a lot of that sort of AI at the edge, like monitoring crops in a field or things like that, will probably have some quite novel bespoke hardware that has been developed specifically, let's say, to analyze pests or things like that, or to ensure crop yields, or yeah. So I think all of that stuff, the dynamics of it are very important in financial services.
I think there's an interplay too with the, you know, everything's happening at once, but the nature of the organization, you know, there's obviously lots of narrative and lots of, you know, studies and thinking on the future of work and the future of organizational design. And, you know, our view is it's at a super high level, move from the sort of Taylorian vertically integrated 20th century local optimum to some more sort of networked ecosystem of nodes. And in that context, like as you said, the way you know, just to use the example of buying enterprise software, for instance, you know, you can see that I think there's a reasonably robust logic that in that old paradigm, you know, also the local optimum was standardization, top down, you know, systems of, you know, universal systems or software. Whereas in this new paradigm, it seems to me that the local optimum is going to be much more this emergent, where competing. So, you know, where it's the end users are deciding. I've often wondered if I don't believe I've ever read anybody that's really looked at this hard, but where the optimum point is between the power of emergence and the, you know, chaos sort of thing. And you know, where's that from laminar to turbulent flow. And actually, even for an organization as small as Anthemis, I know, you know, I sort of, in my own head, get sort of caught between everyone should use the tools that they're comfortable with, because, you know, that they're happy with, because I want, you know, everybody should be productive. And yet, at what point, if everybody's using a different, I don't know, different database or communications channel or whatever, then it's just chaos, right? But I know intuitively to sort of mandate that everybody must is not optimal either, and you know, is actually can be not just not optimal, super counterproductive. So I don't know if any, and Anthemis is super small. Like I can't imagine an organization, you know, organizations when you start talking about thousands or tens of thousands of people. Actually, maybe in some ways it'd be easier because those emergent functions would at least have scale in and of themselves, right? There'd be more signal. I don't know, maybe.
Yeah, that nicely brings us on to moving the conversation away from where the opportunities are in terms of B2B, consumer, or deep tech, to where are the business models? And I think you hit one of the two variables. So one of the variables is they sit on that edge between where there are two forces that are being tuned against, where it's not you know, the Goldilocks zone. And I think most business opportunities do sit on these things. For example, we know that let's say there are negative effects of being too extremely fast or too extremely slow. There's always an optimum, and I think the best business models sit on these things. And the second idea is that where those new opportunities lie, that idea of the adjacent possible, i.e., every a bit like those what is it, the Dadaist game where you make a drawing and you don't see it all, but you draw based upon what you see the last bit of the last drawing. Each startup opportunity is a product of the previous one. And so where we're seeing these gigantic companies emerge, like Stripe or Coinbase or things like that, that's where in the periphery of those, they create a new adjacent possible. They create new pockets of opportunity, and those things sometimes are even bigger than the things that spawned them. And I think because we've seen so many, you know, I mean, only a year or two ago, all the discussion was around unicorns, and now we're seeing, you know, dozens of companies above 50 billion, and some at 100 billion, and a couple at the $250 billion in the fintech arena.
Yeah, and we're seeing ExxonMobil disappear.
Yeah.
Yeah, I think that's interesting. Or, you know, that it's one of those things that was to be expected, but when it actually happens is remarkable in a relatively short period of time, right? Not overnight, but not, not sort of history books kind of time scales.
Yeah, and so on that, I was going to ask you where you think, I mean, that the things that have piqued my interest recently have been things like do not pay, the sort of what I call the activist business model, and things that get rid of forms,
Yeah.
and also things that are not batched, they're continuous, i.e. like a dial up, dial down mortgage or something like that. These are facets of or types of business model that I think can be applied anywhere in financial services, but I don't have the financial services background to necessarily know the specific financial products that are creating opportunities at the moment. And I know you probably have a view on
Yeah,
that.
I mean, I think we definitely live in interesting times, and I know there's there's sort of a saying, everybody thinks that they live in interesting times. And I guess maybe all times are interesting, but right now it's clearly a phase transition. I think just it's so clearly from this industrial world to this information world. And in the context of finance, I think there's there's two big things that I try to use as sort of substrates or framing. One is and that I think are different now, and will lead to different business models and different manifestations of financial products. So a lot of the financial products is, I think we discussed on our first one, and the fundamental quarks or atoms of finance are unchangeable, but how they're put together and delivered and packaged changes. And one is on, I'd say, the sort of demand side, which is, and call it 20th century, but it's even post the sort of the apocryphal or apogee of this was the post-war 50s, 60s, where it was also very non-diverse, right? So it spoke to more homogeneous populations, countries or regions, homogeneous in every sense of the term, on all the sort of diversity of cultural biases, but also in terms of life cycles. So, you went to school, you were educated for 15 to 25 years, and then you worked for 35 to 45 years, and then you retired and you died after 10 or 15 years. And all of those numbers, you could maybe there was some dispersion, but it was very tight, and the normal curve worked. Like there was bell curves, and these were the standard sort of populations. And they used to joke, insurers used to joke, you can give me a postcode in the US or in Canada or Australia in particular, because these are sort of newer societies, so they really were homogeneous. And I can tell you exactly just give me the postcard. I'll tell you what the size of the house is, how many rooms, how many appliances, how many, that. So you deliver, all of finance was then optimized to deliver against that opportunity. And so it was all about economies of scale and sort of mass produced, sort of the Model T Ford of finance became but by the end of even starting in probably the 80s, and certainly by the end of the 90s, that was already sort of obsolete. But the inertia of those models is such that, and I'm not even sure that there's a lot of explicit acknowledgement of those models. I think smart people knew. I don't think it was something that was talked about. It was a little bit like the fish in water, right? It was just, that's the way life is. So that, and that's very much changing. There's so much more heterogeneity of life stories. Any dimension you want to pick, but the average person in that world would have one or two jobs in their lifetime. Now, it's, I don't know, it's 10 or 15, or maybe that's even that framing becomes like nonsensical going forward. And then, so that's sort of the demand side. And on the supply side, there was a lot of sort of operational, to use the sort of the broadest term, constraints. And, a lot of those operational constraints were down to technology, communications and compute technologies. And then finances, anytime there's sort of those constraints, the inertia is double, and this is not necessarily a bad thing. This is like not a value judgment, but because it's a regulated business, it should be, because it's a systemically critical business, sector of our society or economy. It is thus needs to be regulated, and so regulation just adds another layer of sort of inertia to the, and inertia can be good and bad. So usually in our circles, innovation, inertia is seen as like a bad thing. Here, I'm using it in the neutral sort of literal sense. It's like a nautilus just adding weight to any sort of change. And so these pendulums swing way too far. And I think just to finish, I think we're in a world now, or certainly we were, let's say 10 years ago when we started Anthemis, where you had all the models on both sides were built for to be perfectly optimized for 1969. I don't know, and we're in 2012 or 13 or 14 or 15, and the world has changed. And just now, I've just felt in the last maybe 5 years, maybe even 3 years, there's so much left to do, which is super exciting. But I think there's a more generalized acknowledgement that these models will all have to be torn down and rebuilt. Not because they were fundamentally bad. It was just they were of another time. They were optimized for another context. I
saw that when in all the fuss around GameStop and sort of Robinhood trading in general, the discussion around settlement times, and to your point about inertia, where really T+0, you want instantaneous settlement times for certain types of transactions, for payments and things like that. But where there's any form of marketplace or where there's any counterparty risk or something like that, you actually want these time delays to create the market, if you like. And that's
I would frame it slightly differently. I often talked about and this is like bastardizing physics or thermodynamics, but the law of conservation of risk. Yeah. So to use that exact example, when you have T plus N, you have all these sort of risks that can be, that we saw. And you need to, counterparty risks and collateralization, central clearinghouse, whole sort of sense. So if you go to T+0 or real time, instant, real time trading, some of those risks disappear, but they're replaced by different risks. Mm-hmm. I don't have I do have some views, and it's down in the deep. But I must admit, I do get frustrated when the narrative, and actually I get doubly frustrated because it's often by people that absolutely know this and are deliberately sort of obfuscating because they have a view. There's nothing wrong with having a view, but I think they're being dishonest by not sort of admitting this conservation of risks that one, I still think you probably can argue one is better than the other, but not like on some absolutist basis. It would be because on the balance of the alternate risks and technology that's available to mitigate them, blah, 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 one is better than the other.
And so do you think there are specific new business models that haven't been exploited in marketplaces here for new financial products or for new, particularly in insurance, for example, where...
Yeah, absolutely. And at a super macro level, which is not very helpful. So I can say it without any, there's no proprietariness here because this is a completely useless piece of information in terms of action. But I think it's true. I would say the idea of dynamic and self-adjusting finance, whether that's insurance or payments or credit or savings. And that is because of basically asymptotically the cost of compute and storage going to zero, right? And the ability for people to have supercomputers at the edge of the network, in their pocket. I think we're only scratching the surface there, and that's where very much I think part of it is, sort of technological, but most of it's just sort of creative, like inertial, and inertial again in a neutral sense. Where the inertia is on the client side as well, too, right? So we are all and especially for something like finance. This is why I think finance is, one of the reasons it's fascinating is because it's so important. there's actually, it's not only neutral, there's a good inertia on both sides. There's a good, like, I don't want to know if I want to be on the cutting edge of experimenting with something new, with something as important as finance. I get, it'd be the same as like a pacemaker. I definitely want like the best technology, but I don't know if I want the experimental stuff. So it's always a fine line,
That was always, the space shuttle used to have a 386 chip on board, because not just because it was old, but because in those days chips were around for a lot longer. So it had been developed. It had been in production for like 8 or 9 years or something.
Yeah.
And so everyone would take their laptops up for the non-critical stuff, but the actual life support system would be running on this obsolete hardware that was pretty bug-free in terms of. And just going back to that point you made about, again, about the real-time versus not real-time. Something I'm trying to wrestle with is computers tend to lend themselves, like you say, to continuous pricing, to continuous operation instantly. Whereas actually there are advantages in a lot of finance in transactions that are held open so that you can do all sorts of other things, like not have to post the collateral, or like that time gives you something. And it's almost like the analog world of slowing everything down actually created lots of opportunities. Particularly in things like lending, where where a loan prints money, and then the money is, once that loan is redeemed, the money goes away again. So there's something about the financial system that benefits from the right amount of slowness, or the right amount of, and what I'm
I would say, I would frame it even maybe a slight more is time. And this is, options trade, time has value, right? So time is a variable in and of itself, right? And so I would say that's the general case, and what you were alluding to is a specific case is in the series of equations. In certain cases, that the value of that time, manifesting that, optimizes the series of equations, sort of thing. Having that longer or shorter or what have you. It's not, I guess what I'm trying to say, I'm not articulating this very well. It's not sort of like, it's part and parcel of the system. It's not like some separate thing that's sort of happening in the background. Time is, because if you think of finance, like, again, coming back to like the quirks of finance or whatever, the fundamental level, it's like everything, every person, every business, every, and now even probably every object, has a series of, it has a series of future flows associated to it with a certain degree of probability. It's almost like maybe there's some sort of Schrodinger's wave equation for finance. We see a particle world, but it's actually a wave world.
That's kind of what I'm alluding to. So once you hold everything open, it's not just one end state. It probably has multiple possible end states depending on how it collapses. And I'm not sure where computers help there, to be honest, because it's probably it's an NP hard problem, and it's not a thing that current computers are good at solving, and it's not something.
That's actually, I hadn't thought of that. That's very possibly true. But the way I was thinking about it is that there is enough. So to come back to something a bit more concrete, take an individual, right? So consumer financial services or whatever, an individual. There's an infinite number of paths and possibilities from a purely sort of mathematical point of view, but from a probabilistic point of view, you can, and especially with a lot of compute, you can probably narrow that down quite considerably, and especially if it can be dynamic and sort of regenerating every second, every minute, every year. I don't know what the granularity. It's probably variable. Then you can turn what is probably, or almost certainly academically or theoretically, an open-ended problem into a good enough, it's sort of almost like a Monte Carlo simulation, a good enough closed set. But that
would be possible to have a mortgage that you can borrow more anytime continuously, or pay it paid off continuously with the fee for paying off that loan.
I would go one step further, and this is like this is what I talk about the customers having inertia, is actually, you don't care about your mortgage. You care about, having a home, having assets, having, the ability to make choices that are facilitated by finance in the future. And all of finance is essentially, this is, I'm gonna see if I can start a, you know, this is like the Judeans People's Front versus the People's Front of Judea. But I think all of finance is essentially about asset liability management, right? And, you know, what, again, so it's even at the individual level, and, you know, in Amazon Bay, I threw that in there, this obscure reference to perfect asset liability management. What you want is, you know, as David Galbraith, going through life is, if you had some sort of agent that was constantly optimizing your asset liability management, which is based on two things: your stocks of assets and liabilities at that moment, that is knowable, you know what that is, and then your flows going forward, and that is not, that is somewhat knowable, and to differing degrees. So if you had a civil servant's job in France, it's, you know, there's one component of that anyway that's highly knowable, and if you're a freelancer, you know, maybe it's, you know, it's very unconstrained. And then, you know, every step forward in the game, you re-optimize for that. So in that context, I can, you know, it's a bit science fiction, but you can imagine a world where on Tuesday you have all these terms would become irrelevant, but to use old world terms, you have no mortgage because the optimization was everything goes some, and the Wednesday you've got like 120% mortgage because there was an opportunity in terms of asset liability. This is way oversimplified, but, you know, to go all in on Bitcoin for 24 hours or something like, you know, on the asset side.
And I know that if I think of what I don't understand, and this product may exist, and I don't know in terms of neobanks, but where, you know, the old model of let's say from your bank account of having a current account, which you don't need because you can have a wallet, and a savings account, which makes no sense because there's no interest rates. Why the resolution hasn't happened combining the wallet with the robo-advisor, by the neobank that is just the hybrid of robo-advisor plus wallet.
Yeah, I think that's coming. I think it's partly, I don't want to patronize anyone, it's partly this sort of inertial thinking, you know, but I also don't, but it's not just on the part of the entrepreneurs or the businesses or whatever, it's also on the part of the customers. So, you know, you have to get your customers to buy into it. And there's like examples of that. I remember when, you know, these ideas aren't new. Like, I can't remember what they called it, but when Virgin Money came out with their like sweep account, which was a combined sort of current account mortgage. And there was, you know, and it was exactly that. Money is fungible. So I have a net balance with you, positive or negative, it doesn't matter, but I have the net balance. And so, but also then Virgin Money has to work within that context, the way it actually worked, you know, physically. So there was a savings account and there was a mortgage because from a regulatory point of view, that was the kludge that they had to have. And they just put you know, I don't want to diminish this, they put a nice user, you know, user experience on top of that so that you didn't necessarily have to see all of that as a customer. And that's probably where we're going to start. And we're already seeing that a bit, where it's about putting a presentation layer or a great user experience on top of a sort of a kludgy, you know, old school Lego blocks. But at the same time as that happens, you get these new Lego blocks that are being built. The Stripes is, you know, the obvious poster child of that, but many, many others. And that's why I'm so optimistic that I think, you know, it really isn't a science fiction-y future thing. Like within 10 years or so, you know, all those new sort of modern Lego blocks, you know, the 5 lines, the apocryphal 5 lines of code will exist probably. And, you know, in the intervening time, so that I think is a very low risk prognosis or forecast. A higher risk is, but I think plausible, and again on those sorts of timelines, is that we as customers, and generational change helps in this, but even old folks like us will get used to this idea of, like, you know, this new type of finance, which is the fundamental underlying components of it are the same, but the way it's delivered is very, 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 very different, and probably to my point about sort of holistic, much more sort of holistic. And right now we're forced as customers, and maybe we have good advisors, and maybe there's and sometimes that's true, I think, but we're forced to basically, it's like a DIY shop. We're forced to go buy our 2x4s and our nails and our glue, and then build our financial house.
And so on that note, I mean, in terms of, it looks like the sort of the components of new infrastructure there are several infrastructures worldwide, as we know. It's different in the US, different in Europe, different in India, different in Africa to a certain extent. The Lego blocks therefore will be different. Some of the Lego blocks are actually interoperable between these regions, but they have different sort of superpowers in each region. And then there's the glue that fits the Lego blocks. And the glue is the things like the primary API. And it can be anything such as Stripe, or it can be Reliance Jio, a telco handling you dealing with the regulator ultimately. So what I'm amazed by, though, is how few endpoints there are in these like Stripe has, maybe it's buried more within its documentation, but surprisingly few. I'm amazed at how simple Stripe is. It's still a payment system fundamentally, merchant account, meta merchant account, and there's only one or two endpoints that are the bulk of this sort of $95 billion value. So it's not like there's a lot of Lego blocks behind it, and that leads me to think, well, how it is heterogeneous financial services, but it's still not clear how a Stripe ends up being the API to everything in financial services.
No, I think that's right, and I have a tentative idea that finance will become more and more T-shaped, of the business models, and where there'll be some of these mega horizontal layers that are potentially quite thin but absolutely critical, and where there are true economies of scale and network effects, and then on top of those, and some of those will be truly massive, some of them will be quite nichey, possibly geographically or but sort of these horizontal infrastructures or building, and then on top of that, so the T shape or below these sort of highly tuned, verticalized, that might be by customer type, by community, it might be by industry, or even within industries, it might be, within functions, or, and prior, it was almost impossible to do that, or maybe there was only one or two examples. One might be like oil and gas financing and banking. And, if, again, all the component alone is alone, but it was very, very specialized and narrow, because the segment or the vertical is massive enough that, you could build a giant business on that. The future I see is actually that sort of economies of scale no longer is a constraint. So every sort of, vertical node for whom it is of value, like there is, there's incremental value by optimizing the series of financial products, payments, credit, investment, insurance, for that value chain, that can be built.
So do you think the 5 lines of JavaScript gets built in those verticals? Or, the reason I'm saying is that there's 5 lines of JavaScript for lending as a firm. There's 5 lines of JavaScript for payments. There isn't insurance.
So there's 400 types of lending. I just made that number up, but I think it probably is higher, but depending on how specific you want to get. I think I'm being a little bit obtuse here and oversimplifying. I think there'll be that 5. I don't know if 5 lines is. There'll be that's a shorthand. That's everyone that's watching. Don't take this literally. There could well be the 5 lines of code for each of those, and so those verticals. Some of them are more complex than others. Some of them might be. It might be 5 lines of code times 1,000, right? Where they're taking all these different components and they're, optimizing it for that specific. Others will be,
But we know that weirdly, e-commerce was the route for the 5 lines of JavaScript for picking off a massive business for lending and for one type of lending, as you say, and one type of payments.
So I think what's interesting in those models where they scaled is that is actually a distribution angle, right? Because that type of loan, it's one specific type of loan. It's very sort of simple and like well-known. The challenge historically has always been distribution. That's why you had store brand cards. That's why you had Bank of America and Chase like doing all sorts of like, it's all about branding and distribution and
also playing into fragmented markets where you couldn't be blocked initially. And I think that was characteristic. Even although you see that, let's say a firm has to do a deal with Shopify, in the end they have to do it, or Stripe again with Shopify.
But only when they get to a certain scale, right? So
because these things there's always, the long tail never allows you to grab the market completely, but it does allow you to get a toehold in the market. And I don't know where these long tails are. In a lot of B2B markets are so lumpy because it's big deals and big corporations that I think it's harder to pick off these opportunities in these, even if the end goal is actually bigger. But it'd be interesting.
It makes a different go-to-market. So to oversimplify, if you're looking at a highly commoditized, gigantic market like consumer point of purchase credit, or installment credit, then almost by definition and almost forever, there's always going to, it's so, because it's so big and because it's in some ways so simple, or like undifferentiated, not simple, undifferentiated, there's always going to be an opportunity to sort of come in. And if you can build a better mousetrap, bootstrap your way to success. In the sort of enterprise space, I think it's more about, right from the start, having a clearly better mousetrap sort of thing. Because even if the absolute size of the opportunities can be commiserate or even sometimes bigger, the breadth of them is much smaller. So the idea of sort of getting a toehold and then building into it, I think, is a less likely to succeed business model. It's more about, okay, I've got a better mousetrap. I know how to solve this in a fundamentally better way. We always say we exaggerate a little bit, but directionally, I think it's this. It's not about, and in those markets too, it's not when I say have a better mousetrap, it's not 10% or 20% better mousetrap, because the inertia and the switching costs are much higher than that. Sort of, we use a rule of thumb like order of magnitude better. It doesn't have to be order of magnitude better on day zero, but at scale, that's sort of what gets us excited. And surprisingly, there are more things like that than you would think, because you might think, oh God, that's an impossible barrier to like build something that's an order of magnitude better than what exists.
Well, that comes back to design again. I mean, Stripe was a better mousetrap than most implementations if you wanted a merchant account and payment gateway. It was hard and inelegant, and I see it purely as a design product in that sense.
And they saw as you said, the adjacent possible, which was in a world that was moving to online commerce. Actually, there was something in narrative around the recent funding round, which obviously been in the news the last few days, where I think Patrick said their GMV, the payments process is bigger. Their market share, which is still in the greater scheme of things small, is bigger than the total e-commerce GMV when they started.
I mean, that's it. Is having gone through that .com era, when I look at the numbers that were involved in the .com era, how small the internet was compared to now, which is why these valuations are not crazy now to some extent.
Yeah, and it's take the question of Stripe. It's always a bit chicken and egg too, because you could say, and I have heard people say this, oh, the big payments processors, the big merchant acquirers, they were so stupid. Why didn't they? But when you were 10 years ago, or 12, 13 years ago, to that point, tiny market, tiny merchants, your business is not at all built to serve, David selling, painted Easter eggs out of your home. It was a completely rational decision not to serve that market with the business model that they had, and that's what the Collison brothers maybe spotted. I'm super oversimplifying, but they spotted that market wasn't being served for good reasons, which is always better. If it's not being served because people are dumb or accidentally, then it's more tenuous, because as soon as you serve it, it'll be served, and that it was going to grow, exponentially.
But it also has there is something about addressing the little guy. I mean, Square did that offline. It was micro merchants offline.
It's super powerful, yeah.
And I wonder, I mean, that brings us on to the one that
if you can serve the little guy, you can serve anyone if you choose to, right?
But it leverages the power of networks. And I think the one that sort of leads me on to do not pay, my favorite topic, which is, it seems to have two aspects, that model, that make it super exciting. One is it's actually about numbers. It's about leveraging all the little guys to do something that normally where the power dynamic is reversed, whether it's contesting a parking fine or some piece of bureaucracy. And the second thing is that it's leveraging numbers to do something that is fundamentally a new way of looking at the world, which, as I said before, is the statistical way, the non-forms way of the world. And financial services was stuck right in the middle of a business model around filling in forms, largely.
Still is.
Yeah. And everyone hates filling in forms. And actually, we don't need to. And we know that most of the slickest experiences online are now where you replace forms with biometrics or something where it just sort of magically happens. And you're like, what? I didn't fill in a form. And so the activist business model where you not only turn around the power dynamic of bureaucracy and allow lots of people who normally hadn't got access to something to actually have the power, that collective bargaining dynamic changing, to also just getting rid of bloody forms, and like, that's utopia for me. That seems like the which is why I feel the next Stripe is somewhere in there. It emerges from that because it's more powerful in terms of its benefit and its transformative sort of look or way of working, if you like.
Yeah, no, absolutely. That's my utopia as well, where everything's just connected. And I just even think about like tax filing and things like that, where it's like, this is, go figure it out. All the data's there, it's all online somehow. And if I have to authorize it, that's okay, I can do that.
I mean, most of us would in a heartbeat pay lots more money and pay more taxes and things like that just to avoid the hassle. And it would be, I mean, even on the business side, it's why we're seeing, I think, merging of balance sheets and accounting systems with bank accounts is like, for certain businesses, the downside of keeping them separate is worse than the upside of just having some simplicity.
Yeah. And I think, that's sort of a little bit like the time thing, is that the BMI but is the answer to those questions. Because I should say often, it's not often, but not infrequently get asked about, should a neobank become a bank, or, and the answer is typically skews to no, but the real answer is it depends. And it's all about, it's like, do you ever watch The Mighty Boosh?
Yes, love that.
There's a skit called Milky Joe,
right?
I think. And there's a dialogue in it where Noel's it's all about context, and it's like really stupid. It's about how cutting hair when someone's asleep, but it's a great line. Most things in life where it's all about context. It's not yes or no. So that's the other thing that I think is really interesting about these business model discussions is, we're going from, as I said earlier, probably a local optimum of, at least 50 sort of post-war, but I think you can make a case even for like 100 or 150 years of sort of like modern industrial age finance, being optimized for 100, 150 years against a specific context or multiple contexts, and then that context shifting, fundamentally, and finance having to, again, I think starting 10, 15 years ago, having to sort of start again in terms of adapting itself, because finance is very much I believe is a societal infrastructure, right? So it needs to adapt itself to society, not the other way around. That creates, just this Cambrian explosion of opportunity set in terms of experimenting with, how does technology, it's not just about technology. Technology is often the tool or the enabler but you really, I think you have to look through that and say, okay, how is our society, how are our economies, and and our societies changing, and how do we best deliver financial services and products to facilitate that that new paradigm.
So I think, speaking of new paradigms, I think we have to each time look at something that's contextual to what's happening now. NFTs are obviously what the last month people have been engrossed with. What's your view on NFTs, if anything?
Yeah, I think it's really interesting. I think there's a classic sort of speculative fervor, which these days, with Christine Lagarde and Jerome Powell printing more money than ever, the speculative exuberance has occurred throughout history. So that's not, I don't think it created that, it just amplifies it. So it's quite interesting from that point of view. And I remarked that there must be a remarkably large number of very, very wealthy people, at least in dollar terms or euro terms. So that's,
some people are, I mean, it looks like the Beeple piece that was bought for, how much it was bought for, can't remember.
9 million or something. Yeah.
Will be securitized, and they'll try and make the money selling the bits of it. And it does look like it's a very circular kind of arrangement where the tokens that it's securitized into, Beeple owns 2% of them already. So it looks like
no, but I think it's like so some more serious answers. I do think it's really interesting because it's it's at the vanguard of using these new technologies to store and transfer value. Like it's sort of a petri dish, or I don't know, I'm trying to think of the right, but it's like a pilot. I think of it sort of as a pilot for how these things could, and the fact that the focus seems to be on like cultural assets, I think is great or interesting, because it'll capture, even if you can't participate because you don't have $70,000 to buy a crypto kitty or $50 million to buy a Beeple, because they're cultural goods, it actually captures the attention of many, many more people than. So for instance, I think it's much more interesting, I think, from that point of view. And when I say interesting, I mean like a societal level, like than like the ICO craze of like I can't even remember when that was, which was just basically a bunch of Ponzi schemes.
The interesting thing about that was you could argue that that's what's led to innovations such as SPACs and direct listings and things like that.
Yeah, no, so I was good. I didn't want to stop on just a bunch of points because there was some interesting underlying stuff. It kind of got hijacked, actually. There was some interesting stuff. It kind of got a bit hijacked. And I don't think, when I say it was a bunch of Ponzi schemes, what I meant is in the context of like the public attention or, and actually people did get sucked in mostly to the scammy ones and not the interesting ones. And so that was it is a step on the road, but kind of a negative or, like not, whereas this NFT phenomenon, I mean, let's see where it goes, I think is actually more interesting because they're cultural artifacts for the most part right now. A lot of the activity is in virtual worlds like video games, and so I think it's more in the zeitgeist of like today's real world, right?
Yeah, I mean, the term I was sort of banding around was non-fungible utility. What's the if the value is to have something that isn't just a trading card, it has value because it's a trading card in a game, therefore it's digital, then there is some utility component to it as well, which is very like what happened with ICOs, where the tokens had this sort of monetary aspect and utility as well. And I think we might see that.
Other than the utility part, though, was really questionable.
Yeah, exactly. Well, it is, and frankly, in NFTs, the art is very questionable. A lot of it, so it's like
eye of beholder, right? Eye of beholder.
Well, I mean, it's the tail wagging the dog. It's like how many people have actually looked at the Beeple piece? Like, if you were to ask people, what's your favorite of the 5,000 images in that Beeple piece? I reckon most people, like myself, would not be able to answer that question. That people are more interested in it's like being, frankly, no different from the art market itself. Is people are interested.
There's a lot of parallels with the art market, right? Where there's certain artists, who are their work is really a store of value. It's a commodity. Yeah. It's self-referential, and then there's others that are because people like them. And there's a Venn. I'm not suggesting that they're completely separate, but if you're buying a Rothko,
I did as an experiment. I looked at, because Le Corbusier as an architect was a painter, not a very good painter really. He was definitely a much better architect. But the architecture is the premium for a Corbusier building. There was one for sale in a Paris suburb, was maybe 10-15%, something like that. But obviously per square foot, the premium for a Corbusier painting is still like thousands of times more than like someone sitting in Montmartre churning things out. So there is something about the portability and the characteristics of the store of value there that are very important.
I think it's super interesting, and actually, again, because it's burst onto the scene, and perhaps there was no other way it would, but I haven't given that much thought. But irrespective, it sort of burst into popular consciousness in these cultural artifacts. I think that's a really, really good thing, because the underlying technology, and I don't necessarily mean the code, I mean the idea of being able to transfer value, digital value, and store and transfer and trade digital value, is super important, super interesting. Clearly, we're heading in that sort of direction, and this is what the blockchain maximalists have been saying since the beginning. But what I think is interesting is I think our learning curves as a society and as people involved in finance or in the industry will be faster because again, it sort of captured this popular zeitgeist, and maybe that's a tautology, maybe that's why, but
I mean, pulling it back full circle to our conversation of deep tech and why deep tech didn't work, where we said that deep tech was really where the intellectual property had some value, that you can imagine one of the sort of dysfunctional aspects of intellectual property is things like patents have just become an arms race amongst giant corporations, and they have almost no value for the little guy.
Yeah.
That you could imagine NFTs at the moment don't represent intellectual property, but if they did, if we do have some analogous disruption like what happened to the public markets after ICOs and things like that, where there is a new network, a single internet of intellectual property, if you like,
Yeah.
that you could imagine that it would be a very healthy thing, and it would actually reward people who create things. Because at the moment, one of the toxic aspects of open source is the dirty secrets. Is a lot of people who like doing things do things for nothing, and
Yeah.
corporations benefit.
Yeah.
And creative people who create intellectual property have no mechanism unless they're very large to reap the rewards. So I'm optimistic that I think that's how the NFT story plays out over time, is that we see some genuine advantage for intellectual property.
Absolutely. And there's an element of like, the reducing transaction costs again. And so enabling, microtransactions. It comes back to a lot of the interesting stuff, and is technology is enabling stuff that to be universal, where previously there was, certain very, high barriers to economic viability. It wasn't because the financial service provider were greedy or evil, maybe they were, but like that wasn't why. It was that fundamentally, use a merchant acquiring, fundamentally the infrastructure that we have, the business model we have, doesn't allow us to profitably sell to anyone who does less than $5 million of turnover a year, for instance. And all of a sudden, you can, because of technology, I think NFT is in this sort of vector. All of a sudden, that number can be $500 instead of $5 million. And with NFTs, I can't imagine a future where the ability to attribute, and it kind of reminds me of iTunes, where they made it easy to pay for a song. So, I'll just pay for it. If the student that has no money is still going to muck around on Napster or whatever, but the average person is like, if you make it really easy for me to pay for it, like all I have to do is say, I want that, that'll do it. And I think NFTs a lot of things could play out in that way, where, there'll always be arbitrages at the edges, but if I want to support you, David, in whatever you're doing today, it's still pretty clunky. It's less clunky than it was 20 years ago. But if I can literally just, micro, pay you or pledge you, or, so there's a lot of hype around it now. But I think I'm more excited about this than I was around ICOs, because, it was clear that was sort of captured by the black hats pretty quickly. Whereas I'm not sure there will be black hats, I'm sure, but like, I think the nature of it and how it's sort of, I'm actually really pleased again, it's sort of exploded onto the scene with cultural artifacts, because it's not, that's not some obtuse financial thing, right? Where a bunch of insiders on Wall Street or whatever the equivalent was for Bitcoin, or, play around. Like everyone can at least feel like they understand it, or, not even understand it, but like they have a connection to it, right?
I'm less optimistic about it not being captured by the bad actors, but I am optimistic about the long-term effects of this stuff.
I think like not only, and again, I'm exaggerating, there was some interesting stuff that happened in the ICO space and good technologies, but it really very quickly degenerated into,
As we know, the crypto universe is the weirdest thing that's ever happened. It is literally this parallel universe of people arguing. and
maybe the talent Lloyd Merriweather launches an NFT.
Right. Yeah. Well,
actually, probably makes sense though. He had a box, I don't know, digital,
like rotating song thing.
So all right, we should probably wrap it up. I think most of our audience is now, either wandered off or fallen asleep, or good discussion. Thanks, David.
Great. Okay, thanks very much. Till next time. Thank you.